All right, let's get into this talk tickers briefing. We're looking at Kirby Corp, ticker KEX, and a really strange situation from their Q2 2025 earnings. They put up good numbers, but the stock, well, it completely fell off a cliff. So what on earth happened here? Let's unpack the paradox of the plunge.
Okay, so this right here, this is the whole story in a nutshell. On the one hand, you've got a solid earnings beat. They did better than expected, which you'd think Wall Street would love, right? But then, on the other hand, the stock had its biggest one-day drop since 1987. 1987! It's just a classic case of good news being treated like terrible news. So we've got to ask, what gives?
All right, first things first, let's look at the actual numbers that Kirby reported. Because on paper, everything looked pretty darn good, which just makes that stock reaction even more of a head-scratcher.
So take a look at these headline financials. They are solid. I mean, really solid. Earnings per share came in at $1.67, just squeaking past what analysts were expecting. Revenue, over $855 million. Also a nice beat. And that EBITDA growth, I mean, up over 10% from last year. If you're only looking backwards at the quarter that just happened, this is a picture of a really healthy company.
And let's just zoom in on this for a second. 17% growth in earnings per share compared to the same time last year. That is fantastic. I mean, this is the kind of number that should have investors popping champagne, not hitting the sell button. Keep this number in your head.
And then, bam, this is what the market did, a 22% drop in one day. It's just a crazy disconnect, right? The quarter they just reported looks great, but investors were obviously looking at something else. They were looking at the future, and they were scared. So the big question is, what did management say on that call that spooked them so badly?
So, to solve this mystery, you have to stop looking at the Q2 results and start listening to what management said about the future. The market hangs on every single word during these calls, searching for clues about what's coming next. And, well, let's just say they heard something they really didn't like.
And this is probably it, the sentence that lit the fuse. Closer to the lower end of our guidance range. You know, in the language of earnings calls, that is a massive red flag. It's corporate speak for, hey guys, things aren't looking as rosy as we thought they would. For big investors, that means the best case scenario is probably off the table, and the risk just went way up.
So what were these scary trends they were talking about? Well, it was kind of a perfect storm of worries. You've got shifting trade policies causing jitters. You've got demand, especially for chemicals, starting to look a little soft. They're even having trouble getting parts for their power generation business. And on top of all that, the hot pricing in the barge market is cooling off, and inflation, especially for labor, is still biting. It's a lot of things going wrong at once.
And this table really puts it all into perspective. On the left, you see the great quarter they just had. But on the right, that's the story they told about the future. That solid EPS beat, well, now they're saying the full year is going to be at the low end of their forecast. That great barge utilization, yeah, that's expected to moderate. And those nice price increases, they might come under near-term pressure. See the pattern? The market heard this and decided to sell the future, not buy the past.
Now, it's important to remember, this didn't just happen in a bubble. A bit of cautious guidance usually doesn't cause a 22% crash. No, this was like throwing a match into a room already filled with gasoline. Other factors were at play that turned a little bit of smoke into a massive explosion. And just look at how quickly this all went down. At 8:30 in the morning, the stock's trading around 119 bucks. The call begins. By 8:45, 15 minutes later, as management is still talking, the stock is already getting hammered in pre-market trading. By the end of the day, it's closed down at $93, a 22% haircut. That's not a gradual decline, that's a flat-out panic. Now, it is interesting to see that it bounced a little bit a week later. Maybe some cooler heads thought the punishment didn't fit the crime.
And here's that gasoline I was talking about. The whole marine transport industry was already walking on eggshells. Investors were super nervous about the economy, about inflation. They were looking for any excuse to sell. So when Kirby came out with their cautious guidance, it wasn't just about Kirby anymore. It was seen as proof that the entire sector was in for a rough ride. People weren't just selling KEX stock. They were selling the entire idea of investing in this industry right now.
Okay, so that's the breakdown of why the stock plunged. But now for our favorite part, the next call. We have to ask ourselves, when the market overreacts this badly, does it create a buying opportunity?
This slide basically lays out the whole argument. The market got totally obsessed with all the short-term problems you see on the left. The demand softness, the trade policy noise, all that stuff. But in their panic, it feels like they completely missed the powerful, long-term strengths on the right. I mean, look at this. Their coastal business is getting 20% price hikes. Their power generation backlog is exploding, thanks to all the new data centers, and they're buying back their own stock. That's a sign of confidence.
So, if we are making the case for a trade here, this is how we lay it out. First, you have to call the market's reaction what it was, an overreaction. Management was cautious, not catastrophic. Second, you pinpoint the real, durable strengths that everyone else ignored, like that awesome coastal pricing and the power gen backlog. Third, you ask, what makes this stock go back up? Well, the catalyst could be as simple as chemical demand just stopping its decline. It doesn't even need to boom. And that leads us to our call. We're rating this an outperform. Our thesis is pretty simple. That massive sell-off created a huge gap between the stock price and what the company is actually worth. Okay, and before we wrap up, the usual and very important reminder. This has all been for informational and analytical purposes. It is not financial advice.